good afternoon, everyone. I'm Jonathan Mills Patrick. Welcome to another episode of Funding Simplified, where I simplify the business funding process, whether that's getting loans through banks, credit unions, and other types of lenders, or whether that's getting funding through investors, giving up equity in your startup or existing company to fund your progress. Today, I want to talk about the lending side. Actually, this whole week, I'm going to be talking about the lending side on the podcast. Be sure you head over and check that out, jonathanmillspatrick.com/podcast or southbound.com/podcast. And today we're going to talk about the lending side and how long it takes to get a business loan in the first place. Now, it's a broken process. I used to be a commercial lender. I spent most of my professional career as a commercial lender working at a bank, large super regional banks, doing loans for business owners. And the old way of doing commercial loans is still hanging around. There are companies who are improving that process, but it's still hanging around. And so you can imagine this idea of meeting with a commercial loan officer, talking to them about what you need. They're asking for a huge stack of documents that you have to pull together for them. Even in today's technology, you're emailing those over. Those are then handed off to a credit analyst who has to take all that information, plug it into an Excel spreadsheet. I think you get the gist here. The process of commercial loans, business loans, is very antiquated even today. Now, there are companies who are fixing this process. A lot of those are what we call fintech, financial technology companies. They're improving the process by using technology. They're using things like OCR, which is scanning of documentation and feeding that information into given fields in a piece of software. They're using things like even electronic signature can speed up the process of loans. But the thing to understand about business loans and how long it takes to get one is you need to understand the process that any application goes through. There's various phases that a business loan goes through. The first one is just the application process. Again, in the old world, an application would have been a paper form that you fill out and sign. In today's world, hopefully you're working with a lender that can capture that information online. That in and of itself speeds up the process. Then once you've put in your application information, that information is then sent over, and in the underwriting, the decision piece, the underwriting, analyzing what's going on with your business, how your cash flow is, what your credit is, all those different factors that go into it that I talk about in some of my resource guides. The underwriting process is next. And again, even that is starting to be sped up through the use of technology, things like OCR that I mentioned, or even machine learning and artificial intelligence are really helping out at various stages. So you go through your application, then you go through your underwriting, and then that information has to be handed off, most cases, to a human who is looking at that information and using their loan authority to make a decision about whether your loan's going to be approved or not. Again, in today's world, technology is improving some of that. There are companies who are doing business loans out there where a human doesn't even touch the loan. Even the decision process is done completely by a computer based on parameters and things like that that are set. So after the application, you go through underwriting, then you go through the decision phase, and then after the decision phase, you start working toward the close phase. And this is where things can slow down even more. So in most cases, you're looking at anywhere from 48 hours to 2 weeks, depending on the lender that you choose, to get through those first three phases of an application, underwriting, decision, all that. And then in some cases, you could be waiting a little bit longer for the loan to close. And here's why. If your loan involves collateral, whether you're giving real estate as collateral against the loan or equipment or anything else, if it involves collateral and that collateral is going to have to be valued by a third-party source, that's really when the closing time on a loan can slow down, particularly real estate. If you're using residential real estate, you can expect anywhere between 2 and 4 weeks before that appraisal to get done, submitted back to the lender, and then they have to check it and make sure they approve of the appraisal. If it's commercial real estate, I've seen that take anywhere between 4 and 8 weeks to get the appraisal done and then get that information back. So if your loan involves collateral, it's going to take longer to get closed. Now, the flip side of that is if you're giving the lender collateral, they're going to feel better about your loan request and have more propensity to approve you. So there's a trade-off there. Trade-off and better chance of getting approved, but taking longer to close. So those kind of things can definitely affect a business loan. Next up on the podcast, I'll be talking about the difference between term sheets and commitment letters. They're things that both investors and lenders use, but I'll be talking about it from a lender perspective. Hope the information helped you. Have a great day.